Hi folks, and welcome back to Meaningful Money. Okay, I'm here at Mara Zion, and behind me is the world famous St Michael's Mount. Been here before, but not quite this close. I'm on a sandbar actually. You might not be able to see, but just there, it's just at the edge of your picture there, is the causeway, which you can walk across to the mount, but obviously only at low tide. And the low tide was about 2.5 hours ago, and the sea is encroaching, so I better be quick. Good news for you. It's about -1 degrees as well, so I'm freezing, hence the gloves. But if you see my ears go blue, then that's why, okay? So the last of our little ultra basic series here, just to talk about insurance, because we looked at saving and versus investment and what the difference is, and we've also looked at very basically what a pension is. So insurance is probably the last one really. It's a term which is peppered throughout financial planning, but is often confusing, and a lot of people don't really fully understand what it means. Insurance really, first, it's been going on for millennia. They can trace sort of contracts of insurance back to sort of 2nd and 3rd millennium BC. The Babylonians and the Egyptians, all clever people like that. But all insurance is the transfer of risk from one person to another. Now I'll go on to explain that in a minute. A couple of terms though that apply to this. Firstly, there's the insurer. That's the person who is taking on the risk, and the insured is the thing or person which is being insured. It's the thing that the risk might happen to, and the risk itself is the event which is being insured against. So the easiest way is an example. I might insure the fact that I might die. Okay, life insurance, we talked about that before. The reason I might insure that is that would cause me, or more accurately my family, some loss, because I wouldn't be able to earn a living anymore. And so I might insure the risk of me dying. But the loss, or it's a financial loss certainly if I was to die, is so big that is either something that I just put money aside for, but more realistically, it's something that I might ask somebody else to insure for me, an insurance company. And they would look at me and look and say, well, you look reasonably healthy, carrying a stone or 3 extra. But yes, we will insure you, and we will charge you a premium for that. And so the premium is the amount you pay to have the benefit of somebody else taking on the risk. The bigger the risk, the bigger the premium, obviously. And premiums are set by people called underwriters, and that comes from yonks ago when the contract of insurance would be signed at the bottom, it would be written underneath by the underwriter, and they would take on the risk at that point. A couple of important principles with insurance. Most of us, if you've got a car, you've got car insurance, at least hopefully. If you've got a house, you've got a house insurance. If you bought a TV from Dixon's recently, chances are they asked you if you wanted to take out insurance, or they probably called it an extended warranty. So most of us probably get how insurance works, but there's some important bits. There has to be, for insurance to work, there has to be something called insurable interest, which means there has to be a definite loss to me if I'm going to take out insurance. So I can't, for example, take out life insurance on the Queen, because if the Queen dies, there's no loss to me. But if my wife were to die, then there would be loss to me. So I have an insurable interest in my wife, but not in the Queen. That's definitely true. So there has to be an insurable interest. There has to be a quantifiable loss attached to the risk in order for me to be able to insure it. So that's the first principle of insurance, really. There has to be an insurable interest. Secondly is the principle of utmost good faith. When I'm arranging with this third-party insurer to take on my risk, I have to tell them everything there is to know about the risk, so that they are taking it on, knowing everything they need to know about it. So in the case of life insurance, for example, I will be asked a whole load of health questions. And if I neglect to mention that I had a heart attack a fortnight ago, and they take on my life insurance risk, this third party, well, if I subsequently have a second heart attack and die, they're going to say, well, you never told me about the first one, excuse me, and had we known about that, we would never have insured you. So utmost good faith, when you're applying for insurance of any kind, You have to tell them the truth, everything that they want to know about the risk. And the third principle of insurance really is that the premiums of the many pay for the claims of the few. Think about this perhaps in car insurance terms. Of the millions of cars on British roads, probably a sickening proportion without insurance, but let's just imagine that they all had insurance. All the drivers of all those cars had fully comprehensive insurance policies. Well, the proportion of those cars which would crash in any given year is small relatively. And so for many of us, we pay our car insurance for a year and never claim on it. But you pay it just in case you do need to claim on it. But because a relatively small proportion of people will claim on the insurance, that keeps the premiums down for everybody. So there's just a million different kinds of insurance. You've got what might be called general insurance. That's house and car and boat and insurance for your boiler in case that packs up. There's life and health insurance. So life insurance could just as easily be called death insurance, critical illness, income protection, perhaps private medical insurance where you pay it so that if you need a serious operation you can bypass the NHS waiting list and go private. There's business insurance. I've just done my proposal for our professional indemnity insurance at work, which insures me in case we screw up really badly and somebody complains and the complaint is found to be correct. Key person insurance. You can insure an important person in your business so that if they go sick you can pay to have somebody else in to replace them or whatever. The principle is that if the loss that you're thinking about would cause you difficulty if it happened, then insure it. But the balance of that is if it wouldn't cause you massive loss, then don't insure it. And that's why these extended warranty things are seen to be generally a pretty bad deal, because if you go into Argos and buy a toaster for 40 quid and they say, well, would you like to pay £10 for an insurance for it? Well, chances are if the toaster blows up after 18 months and it's out of warranty, you'll just go buy another one and it's probably not worth the insurance. However, if I were to die and you calculate the remainder of my working life and my earnings potential over that time, then that's a pretty valuable asset, and so I insure it. I insure my life, and then I just watch out for little bits of fishing wire at the top of the stairs in case my wife is trying to bump me off for the life insurance. So if it's a big deal to you, insure it. So hopefully that's a simple enough explanation. Probably most of us get what insurance is anyway, but I wanted particularly to cover the principles of insurable interest, utmost good faith, and the premiums of the many paying for the claims of the few. Those are the key points really. So that's it really for the mega basics, just 3 of those, but let me know if there's anything else you want sort of explaining at that level. Going to move on next to inflation, hot topic at the moment. I think I said I was going to do that this time, but I forgot. So we're going to look at inflation, very big subject in the news at the moment. I'll explain how it works and what it means to you. So from St Michael's Mount and the encroaching sea, which is now just about 5 metres that way, thanks for watching, I'll see you next time.